Okay, welcome everyone. We're really glad to see you guys. I hope you had a great Thanksgiving. Just one quick announcement. If you are struggling at all with the homework assignment, please reach out to me. We have 2 weeks left and I need you all to start, especially if you're behind, to make sure you're getting your stuff in, all right? Okay, great. Oh, go ahead, Deanna.
All right, thank you. Welcome everyone. I hope you enjoyed your week off last week for Thanksgiving. I hope you were able to enjoy Thanksgiving safely. Appreciate you being back with us. We are in week number 6, financing, and we have with us Ken and Eva. I have known Ken for a little over 4 years, both. I've known Ken and Eva for a little over 4 years, and I still struggle pronouncing Ken's last name.
So do I. I do too.
So for the sake of murdering that, I will let him pronounce it, but just want to remind everyone that I'm here if you need me, and that as we're going through tonight, although I start us off with some questions, feel free to raise your hand if you'd like to ask a question live, or put a question in the chat if you'd like me to ask it for you. It's meant to be a great discussion today, and I think you'll really enjoy what Ken and Eva have to share. So without further ado, why don't we start with ladies first, and we'll have Eva, would you introduce yourself, please?
I can. Can you guys hear me okay? Okay.
Yes.
I broke my headset in a fit of rage today.
Oh no.
I dropped it and rolled over it, but okay, so good. So good afternoon or good evening, everyone. I am Eva Brown, and I've worked with VWise, the program, for, as Deanna mentioned, probably 6 or 7 years at my former employer, Women's Business Development Center. But right now I come to you as a lending and investment manager for community economic development at Fifth Third Bank, which is what we call a super regional bank, kind of placed in the Midwest throughout 11 states. Basically, my role is to work with our different business line, which includes small business, just to make sure that we've got the right products, the right sales distribution strategy, to make sure we're reaching the hardest to serve throughout our 11 state footprint. So I've got a long history in small business finance. I've worked as a lender, I've worked as an underwriter, portfolio manager, I've worked at a nonprofit with a loan fund. So I'm happy to be here. I've had an opportunity to look at your profile. So just again, happy to be here and share any information that I can. So thank you.
Thanks so much, Eva. And I'll throw it to you, Ken.
Sure. Now we gotta practice, Deanna. The last name is Walslaven. Let's hear you say it. I'm putting her on the spot, ladies and gentlemen.
Walslaven.
Right on. Well,
and now we have a recording, so I will go back and rewatch.
Better yet. No, in all sincerity, everyone knows me as Ken, even my students. So feel free to go with Ken, each and every one of you. By way of background, I teach here at Syracuse University in the Whitman School of Management. But that has not been a career-long vocation for me. That's a rather recent occasion. I started teaching 6-7 years ago now at the university. Prior to that, I built and ran an alternative finance company that was in the world of invoice factoring, which will probably come up at some point this evening. But I did that. I built that business, ran it for about 23 years or so before I decided that I wanted to have a kind of a career change and go into something else in this next stage of my career. So in terms of my experiences, I've kind of been there, done that in terms of the sorts of things you're looking to do. I've had to raise money for my enterprise. I've had to enter a market. I've had to differentiate my product. I've had to hire and fire people. I've had to figure out how to brand my product, how to market myself, how to raise money, how to work with people like Eva at the bank. And in doing so, had a unique opportunity to kind of work with, well, over those years, a better part of 1,000 different clients of mine, all of which were small, mid-sized businesses that were entrepreneurial growth kinds of companies. So that's sort of what I bring to the conversation. I always try and support the IBMF however I can, and I've been doing that for well over a decade now. But in any case, I'm thrilled to be here tonight and looking forward to our conversation.
Thank you so much. I will get us started off. And just so everyone's aware, there are a couple of people that might only be able to respond directly through the chat. So if we have any follow-on questions, it might take them a moment to respond because they have to type it out in the chat. So just giving you a heads up there. So just to get us started, would you all mind kind of going through the differences between traditional and non-traditional funding? And with that kind of comes the follow-on of really, some of the traditional types of funding are bank and community lending. So kind of following that, maybe Eva, you could discuss a little more about what offers or what's out there in that route as well.
So I'll get started. So the differences between traditional and alternative or non-traditional finance, I'll kind of just start with really talking about the bank and how the bank views small business lending. So I think one thing that you guys should really understand about bank financing, especially as it relates to small business, flexibility is not our middle name, right? So we adhere to standards, underwriting standards, which we call a credit box, and that box is actually really small, and it gets smaller as the credit requests get smaller. So as the businesses are smaller and the credit requests are smaller, that box is smaller. And so when I say it's a box, there are a few different things that most banks are going to look at, and it's pretty standard. They're looking at, and you guys have heard this all before, but I'll just kind of talk from it from a bank lens, the 5 C's of credit. They're looking at cash flow, right? And cash flow is determined by either your historical performance via your tax returns or accountant prepared financial statements, or it could possibly be a combination of your personal finances and projections. So it has to hit a certain ratio. There's not a whole lot of flexibility around that. They also look at collateral. So there is such thing as unsecured lending for small businesses up to a certain dollar amount. But again, it's very small and strict. But typically when you get into larger dollar amounts, banks are looking for assets to really secure their loan. And if you don't have a certain dollar amount from a value perspective of assets, banks typically won't be able to move forward. Same thing with equity. Banks expect you to put your cash into a transaction before they put their own in. And there's a ratio around that as well. And there are a few different other things, but I think one of the bigger things, especially as we're talking to nascent businesses that, have not, maybe they don't have the same experience as other, gosh, I've got 3 different devices ringing. Okay. So it's credit score. So I'll say this, and I've said this in another class. When you apply for a bank loan, the banker taps it into the system, and it goes into what they call a little algorithm. And the first question on the algorithm is, pool credit score, is the credit score above or below X? Right? And typically if it's below X, it's going to spit out a decline without even going through any of the other decisioning factors. So that's what traditional financing is, a small box. It's not flexible. It's a standard credit product, and they really don't look behind whatever is in those numbers. Alternative financing it looks at all of the same things, but the box is a lot wider. I like to think of alternative, and I'll only talk about one aspect of it because I know Ken, he's had a whole successful business doing that. So I'll let him kind of cover off on some of the other aspects. But I think one of the most important forms of alternative financing is called Community Development Financial Institution. So that's CDFI is the acronym. So I'll say it one more time, Community Development Financial Institutions. So this is a certification, if you will, from the U.S. Treasury that either a for-profit lender, but most typically they're nonprofit lenders, get this certification because what they do is they extend credit to population of people that have typically been left out of the traditional credit market. So these CDFIs, and I chair the board of one here in Chicago, we look at all of the things that the bank looks at, but we look at it and we really want to understand the story behind it, why you're asking for the money, and we're not necessarily 100% driven off of the metrics that I explained earlier. So it's flexible in nature, and I'll give you one example of that flexibility. So here at Fifth Third and other banks, there may be a minimum credit score, like, hey, if you're asking for $100,000, you must have a 720 credit score. At the CDFI that we work for, we don't have minimum score. So our box box is a lot wider. It's not to say that we don't care about credit, but we look to see what's in your credit report that drives that score. What happened? What if there is something that was negative, what caused it? Is there a story behind it? Is there a remedy? Is there a plan to cure that? So it's much more flexible, and I know we'll talk more about that, but I'll pause there because I know Ken's got a lot of experience in alternative credit as well.
Eva, every time we do this, and this is what, our third or fourth time to do it, I always learn something from you. And ladies and gentlemen, if you're looking to leave this conversation with some knowledge about some secret sauce, you just heard about it. The CDFIs, they're very misunderstood, and they are an extremely valuable resource for an early stage business such as yours. Eva, before I get into any more of my stuff, I have a question. Am I correct in understanding that the CDFIs are funded themselves typically by larger banks? That a bank like Fifth Third would fund a CDFI?
Yeah, so the two largest sources of funding for CDFIs are the government. So the Treasury is a great funder of CDFIs, and banks, because we know that we have a responsibility to lend to these small businesses. We do take the money off of our balance sheet and place it on the CDFI's balance sheet. And that's actually what I do in my job today.
So that helps you with the Community Reinvestment Act, the CRA, but at the same time, you don't get criticized for any of those loans, right?
No, we don't. We don't get any.
All right, that's a beautiful thing.
Yep.
See, guys, I'm learning here. I'm learning. All right. So let me say, as Eva properly pointed out, and she analogized her underwriting to the size of a box, and that banks tend to have a small box. Let me say in defense of the banks, however, that they don't make enough money on a given loan to take big risk. Said differently, there's no cheaper form of institutional capital anywhere on the face of the earth. What Eva didn't mention, we take it for granted, but I should point out that bank lending is not dilutive. You're not giving up a piece of your company. It's not like you're going on to Shark Tank and having to give up some of your equity. So in addition to getting inexpensive capital, it's also non-dilutive, which is to say, if you can fit into that box, go for it. And if you can fit into the CDFI's box, which tends to be a little bigger, all the better. So just keep that in mind. So what I want to do is give you some additional information about some of the other alternatives, kind of under the category of, I'm using air quotes now, but what if the bank says no? Or what if the CDFI says no? It doesn't mean the world has ended. It doesn't mean the game is over. There are still plenty of alternatives. And where I made my living for my career was in those alternative spaces. Believe me, there's a lot of business that gets done there because the bank's underwriting can be kind of rigid sometimes. So maybe you've got a business that is too new. Maybe it's had a loss in the last year or two. Maybe it's in a disfavored industry. In any case, you might find that the bank has to say no to you. So now the question is, what next? There are lenders out there who are collateral lenders, I'll say, which are called asset-based lenders, who are going to take more of a risk if you've got a bunch of collateral that they care about. That probably doesn't describe too many startup businesses, but it might describe your business down the road. Will they charge a higher rate than the bank? They will, but they still won't be dilutive. And these asset-based lenders, some so-called ABLs by the abbreviation, believe it or not, as Eva will tell you, are oftentimes owned by the very banks that turned you down. Eva on her side of the bank may say, no, I can't help you. And I don't know about Fifth Third in particular, but they might have an ABL desk that will be able to potentially repackage your loan in a different fashion, look at it through a different lens, and potentially say yes. There are lenders out there called purchase order financiers. These let me kind of set this scenario up for you. Let's say you've just gotten a big order from Home Depot or Walmart or somebody like that, but the order is really big. And frankly, it's bigger than you can handle. You can't deliver on it because it's such a big order. You need a financial partner to build out that order and be able to deliver upon it. There are companies out there that will step up and partner with you. They'll provide you the funding for you to be able to put that out. And while they will take a much higher fee than any bank will, At the same time, once they're done with that order, they're out of your hair. They're not a partner for life. They've taken a chunk of the profit perhaps in that order, but you were able to deliver on the order and you made a bunch of profit yourself. So these asset-based lenders exist out there. In my particular case, I was what's called an invoice factor. So if you're in the B2B environment, if you sell your goods or service to another business, you already know that you don't get paid right away. There's no cash register. Instead, you've got to send an invoice out for your goods or service, and you hope to get paid in 30 days. But in reality, it's going to be 45 or 60 or perhaps longer than that. In the meantime, you've got a business to run, but you've got this asset in your hand. It's called an invoice. It hasn't been paid yet. It has value. You can turn around to a company like the one I ran and finance that individual invoice. Say, you know what? Home Depot owes me $10,000 on this invoice. I can't wait for them to go find their checkbook. Hey, Ken, what can you give me for this? And I will pay you. Typically, on average, it works out to be about 97 cents on the dollar. So you give up a little bit of your profit, but you get your cash up front. Clearly, I'm simplifying things dramatically for this conversation, but I want to alert you to the fact that these kinds of companies, they exist out there. And it all falls under the category of what if the bank says no? To this point in the conversation, I haven't even talked about equity yet. I haven't talked about anything that's dilutive. But as you know, there's a big fork in the road, and it's just as big as what we've just covered. What we've just covered might be referred to as the debt side of the fork. The other side of the fork is the equity side of the fork, where you're going to raise money from an investor, and you're going to part with some of your ownership to that investor. And they will be your partner for life. And there's a whole additional conversation to have about that. We can define angel investors. We can define venture capitalists. We can talk about friends and family. We can talk about lots of different ways to skin that cat. But there are pros and cons to both of these alternatives. Very few entrepreneurs ever think initially, geez, I want to go find an investor and give up a piece of my business. On the other hand, I might add that it oftentimes is a very legitimate strategy for an early stage company, such as many of yours, because in addition to getting those needed funds at a critical time, you might also line up with the right kind of angel investor who can also give you a hand up and give you lots of advice and open lots of doors and help you grow your business. We've all seen Shark Tank over the years. Shark Tank is named that because it makes for good television. But in fact, those individuals are angel investors. They are individuals making their own personal investments. And as you'll see, if you watch the show more than a few times, there's an entrepreneur who goes on there and says, hey, I really want to work with Mark Cuban, or I really want to work with this guy or that guy or this woman. Their rationale is that they want to partner with someone who's going to give them far more than just cash, but rather give them advice and counsel and help them grow. That can be extraordinarily valuable. And that will oftentimes far outweigh the amount of dilution that you need to suffer. So I hope I haven't gone too long there, or I purposely tried to avoid all the rabbit holes that I could have dived down, and I didn't, I don't think. But hopefully that kind of gives us a superficial view of the world. And maybe Deanna, if you've got more questions, we'll go from there.
I do actually. We already have a couple, as Eva was talking about loans and things like that. Jason had a questions on why would it be better to use a smaller regional bank versus a national bank like Chase when you're looking to get a loan?
So I'm not going to say that that's necessarily always true, right? So I think that the sentiment is that smaller regional banks are more flexible in how they approach lending, right? Whereas the larger banks, as Ken alluded to, especially from a profitability perspective, a lot of the smaller loans are just really done auto adjudicated. So there's not really a high touch in making credit decisions. Whereas when you look at some smaller banks, and I wouldn't even say kind of regional banks, but just small banks, you actually do have kind of, credit officers that are looking at each loan. So I do understand that, some folks think there's an advantage that you actually have a person that's looking at your loan and really making that credit decision versus it going through a computer system. But I would say that that's not always the case. Larger banks, there's advantages to both. Larger banks, they typically, they can get back to you quicker. They have faster, decision-making, disbursements. They have ancillary products that can help you with cash management that may kind of reduce your reliance on borrowed capital. So I think it really depends on each. So I think it's just doing your research on each bank.
Got it. Thank you very much. And another question, I think this is more for you, Eva. While you were speaking about collateral that businesses need to put up, the question was, does everyone for any type of business need collateral in order to get a loan?
So the short answer is no, but let me quickly talk about the reason why banks are requiring collateral. So collateral is what we call a second form of repayment, or maybe a third form of repayment. When you're making a loan at a bank, the first source of repayment, and which is why they always say cash is king, is we're measuring your ability to repay the loan by your cash flow, because that's how we want to get paid. But as you know, banks, we're low risk. As Ken mentioned, it's the cheapest type of debt you will ever get. And that's because of we're not taking a lot of risk. So not only if the cash flow doesn't repay the debt, we still want to get our money back. So we try to make sure that we have three sources of repayment. One is cash flow. Second is collateral. Third is the enforcement of a personal guarantee. So there are products, especially depending on what you're borrowing. So if it's not a lot of money, a lot of banks do have unsecured credit products up to a certain dollar amount. So at Fifth Third, we have an unsecured credit product up to $100,000. Now, can a new business get that? No, right? So there are all these different layers of who can receive that. It's based on credit score, it's based on historical performance, it's based on the industry that you're in. So could you possibly qualify for unsecured credit? Yes. But by and large, the answer is yes, you will need collateral. And that could be in the form of business assets. It could be accounts receivable, not that invoice that Ken spoke about, but banks are looking at accounts receivable. So that's actually after you've done the work, you build the client, there's account receivable on your invoice, on your balance sheet, we can lend to that, or personal assets. So typically, as you're starting out, yes, you will need some collateral to back a loan.
Thank you very much. Ken, I believe this came up while you were speaking. Could you please explain dilution, if I'm pronouncing that correct?
Yeah, dilution. I apologize. I went into industry techno speak and ran right by that. I apologize. Understand that the root of the word is dilute. So dilute is used in the sense of your ownership. If you have a financier who's going to take a piece of your business, they are reducing the amount that you then own. They have diluted your ownership from what previously was 100% down to some lower number. Maybe they're going to take 20%. So that would say that you've been diluted down to 80%. So the question of dilution isn't, does it exist in the case of equity? It always does. But the bigger question is, how much dilution do you need to suffer in order to raise the funding? Hopefully that helps.
Yes, thank you. I appreciate that. So I'm going to move on to another question that I had set up for us because I want to make sure that we get to it. Mike Haney, Dr. Haney, who spoke on week 1, talked a little bit about bootstrapping and what that is. But could you kind of expand a little further on what is bootstrapping and how can this concept be helpful, especially in today's economy?
Which of us would you like to point that towards?
Probably Ken.
Okay.
Yeah.
Sure. So let's first define bootstrapping. Bootstrapping is a term used within the financial industry and the entrepreneurial world. And the best way to describe it is to explain that it's about stretching a buck. It's finding a way to be creative, to reduce the need for funding, to build your business with an eye towards stretching a dollar. You heard Deanna mentioned earlier, I think it was Deanna, maybe it was Eva who said cash is king. I guess it was Eva, I apologize. Keeping that in mind. So let me give you some examples of bootstrapping. Rather than getting your first new office, you might choose to sublet from someone else's area, some extra space that they have. You never want to buy new when you can lease. You never want to lease when you can rent. You never want to rent when you can borrow. You never want to borrow when you can steal. I'm only kidding on that last one. But the idea is that you want to stretch a dollar and be as creative as you possibly can. Now, bootstrapping is a tool in our club, it's a tool in our bag when we're entrepreneurs. You'll be amazed at how good and how creative and how innovative we are at stretching a dollar, because it's out of necessity. On the other hand, there's a great advantage to being able to bootstrap, and that is to delay your eventual need for funding. I should say delay or potentially reduce. Let's think this through for a minute. If you can bootstrap and avoid outside funding for your first couple of years of business, how much stronger are you going to look at when you go in to see Eva at the bank? Are you going to get a better deal from Eva than you did at day one? Quite likely. Think about it on the other side. Think about it if you were to work with an investor. An investor invests in your business based on its value today and its projected value in the future. That conversation is an awful lot better conversation for you to have 2 years from now than it is today. So to the extent that you can use bootstrapping as a technique to reduce or avoid additional funding, it is always in your best interest to do that. You'll get better terms when you do choose to pull that trigger. And after all, that is what you're trying to do. Hopefully that's helped a little bit, Deanna. Eva, feel free to add to that.
No, I think you hit it spot on. Bootstrap, as long as you can. And I think a follow-up question that I usually get to that is, well, when do you get bank capital? Versus kind of using your own or bootstrapping it. And I always say, if there's an opportunity in front of you that will help grow the business, I won't say exponentially, but help grow the business, versus just trying to have money to continue to operate as such. But, I always think it's a great opportunity to look for outside capital when there's something in front of you that has the really great potential to grow your business versus just kind of humdrum doing what you've been doing day to day.
That's a great point. Thank you for that. Eva, I want to just talk a little bit more about COVID-19. Has that changed how the banks do business? And if so, I think we kind of know the answer to that, but if so, like what are the changes that are happening that you might see with loans and things like that?
Yeah, so yes, it has. As you can imagine, COVID-19, the impact on small business lending is just kind of far and wide. So from a bank perspective, there's a couple of things that are happening. So one, what we typically do when there's downturns in the economy as a bank, we retreat, right? We retreat and we try to protect our portfolios by all costs. And so what that means is if you're currently a customer of the bank, relationship managers, the folks that are out there doing the lending, they're really taking care. And that's where the energy is to make sure that we're preserving the businesses within our portfolio, to make sure that they're healthy, we're checking in on them, trying to pour as many resources as we need. So that doesn't mean that we've cut the spigot off on lending, but it really does mean that we've taken a second look at, well, who will we be making loans to and putting some additional precautions in place. So whether that be from an industry perspective, so banks are really driven by kind of macroeconomics. So if we know that, there's big things happening in the economy and it's affecting or impacting certain industries, then we look at what does the credit underwriting guidelines look like for that industry. And, to be frank and honest, sometimes, they become much, much more stricter. So, imagine what the credit guidelines, let's be frank, restaurants, right? So restaurants are hard to lend to begin with from a traditional lending perspective, but put the COVID bow on top of it, it makes it extremely difficult. Again, it doesn't say that we don't, but yes, banks do look internally. We look at our procedures, we look at our credit underwriting guidelines, and we look at who's being impacted the most, and we really lend around those type of decisions.
Could I add to that too?
Yes,
A little bit?
absolutely.
Just to echo some of what Eva's talking about. Eva's talking about, the bank's approach, which is as old as time. It's always been the case when you kind of hit a crisis. Remember too, guys, that there's a number of dominoes that fall thereafter, all under the label of liquidity. And when the banks kind of pull back like this, you as a borrower find that you don't have as much access to cash. So what do? You husband your cash. You don't pay your bills so promptly any longer. You do whatever you can through bootstrapping and other means to hold on to your cash, because not only is the bank not there for you as much as before, but also no one else is paying you on a timely basis. And this becomes a self-fulfilling prophecy. This withdrawal of liquidity from the system, you hear about it in the news all the time. That has an impact all the way down that food chain. And as an alternative financier, I was saying to someone just recently, boy, I wish I still had my factoring business, because I bet they're lining up like cordwood outside the front door saying, help me, because nobody's paying people on a prompt basis on trade terms these days. So I would have imagined that right about now, my former industry is doing exceptionally well. There's always some capital somewhere for you. The question is, you might need to look under a different rock to find it at times like this.
And can I add, you made me think of one thing just in the response to COVID. So I think while we may retreat from a lending perspective, we also do increase our investment in alternative sources. So one of the things that I was happy to work on this summer is Fifth Third, like many banks, we had a COVID response, and a part of that response to small business was funding and making more investments into folks like CDFIs and SBDCs and all of these small business resources to say, we understand that the small businesses are going to be in need. And so, for example, just from a share, this isn't even in lending capital, Fifth Third committed an additional $8.75 million into small business resource organizations, so that folks like you guys can go there, call, and get the resources that you need. And I'm not saying that as a Fifth Third commercial, because all of the banks did it. It's kind of one of those things like, hey, if we're not doing, what we've historically been able to do from a traditional perspective, we amp up the resources in the other areas.
Great, that's awesome. Thank you for expounding. You two make a great team, I feel like, on these classes, because you just can continue to add off of each other's answers. So I appreciate that.
Eva, it sounds like we're about to get enlisted here. We're getting drafted.
I know, right? You two make a great team, and now I have another request. I'm thinking about a jam session with Ken and Eva. Friends, families, other fools, and the bank. That's what it'll be called right there.
There it is.
So Ken, I was wondering if you could talk a little bit, and I know I say this each time, and it's not a short answer, and that's okay. Could you talk a little bit about the economic model? And what is it, and what does that entail? I have just recently shared the links to the videos that you shared with me from the last class, so they'll be able to watch those to go into it further, but just kind of hearing it from you today.
Sure. I should remember that this question comes with these conversations. I always get surprised by it. So the economic model, if you've looked at the video, or if you will, you'll realize that it's a way of looking at a business to kind of assess its logic, to assess its internal consistency, to see if this model that you're building makes some inherent sense. The approach to the economic model was created right here at Syracuse and is now used in classrooms all around the country. And it causes you to look at basically 4 elements within your business. One is your volumes, another is your margins, a third is what we call revenue drivers, which is a fancy pants academic term for how many different ways do you make a buck. And then the fourth one is something called operating leverage, which will require some more conversation. But let's first start with the first 3, and let's profile a company we're all familiar with. Let's consider Starbucks, and I think I probably used Starbucks in the video. If you think about Starbucks from the standpoint of margins, let's think about their margins. Think about their unit margins. When they sell a cup of coffee, a simple cup of coffee, not one of the fancy ones. Uh-oh. When they sell a simple cup of coffee, it's as I understand it, $3.50. Let's call it $3.50 for a large grande cup of coffee. Let's think about what the components costs are of that coffee, the so-called variable costs. You got your cup, your lid, the stir, maybe a packet or two of sugar, some water, some coffee grounds, some fractional time of the baristas to make the cup, draw the cup of coffee and pass it across the counter. I happen to know this statistically, that the answer to what their total incremental cost is for that cup of coffee is approximately 30 cents. So they're selling to you something for $3.50 and it's costing them $3. That's a really nice business model. Okay, that we call that differential, that is called contribution margin. That's the difference between the sale price and the unit cost. So the contribution margin in that example is really high. So clearly we'd give Starbucks a thumbs up for margins, lots of margin. And no doubt their other products are similarly priced. The next question is volumes. Do they sell a lot? Well, in their case, they do. I've seen the lines out the door. So they get a thumb up on that as well. But let's stop here for a moment, because you don't have to have thumbs up to on both of these issues to be successful. There are plenty of businesses, I'm sure you can think of some right off the top of your head, that might have high margins and low volumes and be perfectly successful. Or alternatively, lower margins and higher volumes. It just so happens in Starbucks' case that it is indeed high in both. The third element, which is the issue of revenue drivers, think again of Starbucks. While you could say, yeah, they only sell coffee, if you've been in Starbucks, you know that's really not true. There's food items, there's branded product, there's in some cases clothing and cups, and you can buy whole beans, and there's plenty of things to buy there in addition to the myriad number of cups of coffee. So they've figured out a great number of ways to separate you from your money. And I would say that they again have a thumbs up, good answer with regard to the types of revenue drivers. As you can see here, while there's no magic answer, the higher the number of revenue drivers, typically the better off you're going to be. So already you're kind of looking at your business and saying, is this making sense here? Have I designed something that makes sense? Alternatively, if I were to suggest to you something that didn't make sense, if you said I have one type of revenue driver, low margin and low volumes, I would say get ready for bankruptcy court. Okay, that's not what you want to design. The fourth element, and I'm going to try and do this, Deanna, really quick. I don't know if I'll just confuse people or not, but the fourth element is called operating leverage. And what that amounts to is that's simply looking at the business from a function of asking, do I have a lot of fixed costs as a proportion of my total costs in my enterprise? When I look at my enterprise after the course of a year, am I carrying a lot of fixed costs or not? If I am, then it's said that I have high operating leverage. Let me say at the outset here, there's no right or wrong here. There's no good or bad answer. You can have high operating leverage or low operating leverage. It doesn't matter in terms of the success of your business, but it's important to know what you have. Here's why. If you've got high operating leverage, which is to say you have a lot of fixed costs and not a lot of variable costs, which, by the way, would describe Starbucks. Think about the fact, they've got to open the store, they've got all of their overhead, their fixed costs are pretty high compared to their variable costs, which are kind of negligible. In that scenario, as you can see, that scenario, because you have higher fixed costs, you have higher break even, you have a higher risk in a typical business. But the trade-off, the benefit to having a high operating leverage company is that you have high profitability. Once you get past that break even, you're off to the races. You've got a lot of profit from each of those incremental cups of coffee. Let me draw one final analogy, and then I'll leave this topic for the videos. If you thought about an airline, airlines by definition are high operating leverage entities. They've got tons of overhead. Before they fly a single passenger, they're incurring millions of dollars of costs a day. About the only variable cost for an airline is going to be the fuel and the peanuts. Okay, so if you've got a flight from Syracuse here and I want to go visit Eva in Chicago, I might look at a plane and I might, as an airline financial analyst, figure out that in that 200-seat aircraft, my break even might be seat 100. Okay. So what is my incremental cost for seat number 101? A couple gallons of fuel, in my case, about a half a dozen bags of peanuts, but you get the idea, all right? Not much. And the vast bulk of the sale price for that 101st ticket is going to fall to the bottom line as profit. That offsets that reality, which is great reality, offsets that problems that you have with a high operating leverage company where you have high fixed costs, high break even, higher risk. But the payoff is once you get past that, you've got high profitability. The alternative might be perfectly fine for you. You might want to design a business that has lower operating leverage, which is to say higher variable costs, but lower fixed costs. Such a decision is perfectly fine. You're making that decision, lowering your break even, lowering your risk, and trading that off for future profits that aren't going to be quite as robust. If I haven't buggered it up, all right, give me a chance in the videos. It'll mess you up entirely, right? But it's hard to do this in like a 5 or 6 minute kind of introduction. But it's important to, I'll finish off by saying it's important to understand how these 4 elements play together: the margins, the volumes, the operating leverage, the revenue drivers. Do they fit together? Have you designed something that is inherently logical and holds together, or are you creating something and you've got a big blind spot here that you didn't even think about? That's really where the economic model can come into play.
Thank you so much. I know that was a mouthful of a question. And just to reiterate, the videos are posted as an announcement. So you can take a look at those links and dive deeper into that. They're great videos. And I really appreciate, Ken, you sharing those with us. Kind of a question for both of you. When it comes to, it was an interesting question that we had in a webinar we did a while ago, and I kind of saved it because I thought this would be a good question to incorporate into this class. So if someone's looking to start their business and figure out, whether they want to establish business partners or a sole proprietorship, what are the pros and cons for one versus the other when it relates to funding? Do the banks look for something run on your own, or having business partners? Does that help? Does that hinder? And, on the other hand, what, Ken, being an entrepreneur, what is your take on that? Acquiring business partners, or that might even help fund it, or doing it on your own?
Go ahead, Eva.
Okay, so I think, so a business partner, that's a very interesting question. So a business partner, so to answer the question kind of plainly, does a bank look at it favorably or not? No, it doesn't matter. But I'll talk about the impact of having business partners as it relates to borrowing, right? So a business partner can help and or hurt you. So for example, when you have a business partner, anyone that's above 20% ownership, so that's the kind of threshold from a bank lending point of view, anyone that has more than 20% ownership has to be kind of looked at just like you would look at. So if you had 80% and that person had 20%, both of you would be required to submit a personal guarantee on the loan. And so what that basically means is that bank is going to be looking at your credit scores, they're going to be looking at your assets, they're going to be looking at your debt, they're going to be looking at your experience in the industry, they're going to be looking at your whole profile. So it can hurt or help. So if your partner is strong and they know the business just like you do, they've got some additional assets to put forth as it relates to equity, they've got strong credit, then that's a helpful thing, right? That can boost the financial profile of the business. Now we've not only got one strong guarantor, we have two. But conversely, it works the same. If you're a partner that has more than 20% equity in your business, if they've got a challenging financial situation, and that can be credit, or they've got too much debt, or a bankruptcy, that too can impact your ability to borrow, right? So one thing that I was always taught, especially from an underwriting standpoint, one person with good credit does not make up for a person with bad credit, right? So it doesn't cancel each other out. So it's just being very mindful of who that partner is. So I don't know if it's a good or a bad kind of answer there.
Oh, thank you so much, Ken.
In my case, I'm really conflicted on this issue of partners, and I say that from personal experience. When I started my business, I brought on a partner. Together, we were equal partners. We then lined ourselves up with a group of investors who collectively owned a third of the business. So I owned a third, my partner owned a third, and this group of investors owned a third. And it was critical for me to get those investors interested because I had a partner. They cared about that. And they cared about it because although I was the primary guy and the primary link to them as a group, they wanted to know that if something happened to me, that there was a backup, that there was somebody there who could fly the flag. That was important to them as equity investors. At the same time, however, I will say that I didn't do it right, which is to say that my partner and I were clones of one another. And I would urge you not to do this. All right. If you're going to have a partner, be sure that the partner has complementary skill sets. I don't mean that with an I in the middle where I'm saying nice hair day today. I mean it with an E in the middle, complementary skill sets. I want the people that are anticipating bringing on a partner to think about what does the partner bring to the table. Hopefully they're good where I'm not. And hopefully I'm good where they're not. And together we'll make a tremendous team. In my case, my partner and I were kind of clones of one another. We ran in the same social circles. We looked at life the same way. We had the same business experiences. In fact, I had hired him at the last 2 jobs. So as a consequence, I blew that part of it. And in retrospect, I would have done it differently. I think in retrospect, I would have tried to go solo if I had it to do all over again, because aside from the fact that I was able to get some equity money, there wasn't any real value in having duplicates of one another. If I were to bring on a partner, I would have chosen differently to bring on someone who had different skill sets.
Thank you very much. Yeah, I just thought it was an interesting question that we don't get asked very often, and it definitely can make a difference, I believe, depending on the business. So I appreciate that. Just as a reminder, if you have any questions, put them in the chat. This is a really good, someone was mentioning that the chat is quiet, and I think that's good because it's a good discussion and there's a lot of information that's being offered. So I appreciate it. Do you know if there are any unique funding opportunities out there specifically for small business? We've got some questions. So why don't we answer this question that I asked, and then we'll go to Tiffany and Jason. They both have questions that they'd like to ask. So do you know specifically, I know Eva, you teach a lot for our program, and I'm sure some others. And Ken, you work with our demographic a lot. Do you know if there's any unique opportunities out there for veterans, military connected?
So not offhand. There's always a lot of different programs that exist. I will say, especially now, and that was actually my call right before this, a lot of the programs are still focused on COVID relief. And so we're really seeing a gap on programs that are helping businesses that are not kind of in a program, in a position where they need help, like especially as like startups and things like that. A lot of the program is saying, hey, show me that you've been, disrupted because of COVID. And there are a lot of programs out there, and, sometimes they may be for veterans or they could be for women and, so forth and so on. But my advice as it comes to specific programs for veterans, I would say make sure that you're in tune with your local VBOC, which is your Veterans Business Outreach Center,
yep.
Or your Small Business Development Center, because those are really good repositories for this type of information. So when I develop a program at Fifth Third, like for example, we did a COVID grant relief program, I went immediately to a small business organization, AEO out of DC, as my partner to help distribute the information to impact the small businesses. So my advice there is make sure that you connect with your local small business resources, because they likely would have some of that information.
I would just underscore some of that, and just to clear away some of the fog, perhaps. The government has something called the Small Business Administration. It is a cabinet level organization. It's a big deal. And the SBA, as it's referred to, has a number of different arms, and Eva was mentioning a couple of them. The Small Business Development Centers, SBDCs, are found in virtually every community of any size around the country, oftentimes affiliated with colleges. These are tremendous places to be able to get insight as to different funding opportunities and to help grow your business. There's other arms of it as well, something called the SCORE program, SCORE, which stands for Service Corps of Retired Executives. I got a thumbs up from Alan. So either Alan knows about it or he's one of them. But in the case of SCORE, this is another place that can help you. They'll affiliate you with one of their members, one of their retired executives, who can help you with your business modeling and your business planning and think through and figure out what doors can help open. VBOX, we're Veterans Business Outreach Center are another big deal. So the biggest question is, where do I go as a kind of a clearinghouse to get all of this information? I would tell you to perhaps start at sba.gov and kind of whittle your way down through there. To answer Deanna's question really precisely about, do I know of specific funding programs that are set aside for people like yourselves? I don't. It was never really my area of expertise. However, I've heard, and I'll turn to Eva if maybe she knows. I don't know if this is her area or not, but I was under the impression for quite some time that SBA-backed business loans provided discounts in terms of closing fees to veterans. Is that still the case?
That is still the case. So they do have lower fees and sometimes more favorable terms. So maybe a little bit longer terms than traditional SBA loans. So yeah, that's still the case.
Great.
Awesome. Thank you both for that. I'll go to Tiffany now. Tiffany, you can go ahead and unmute and ask your question, and then we'll go to Jason.
Good evening, everyone. My question was basically, as I was listening to you speak about the high margins and low margins, I was thinking, I said, well, as a consultant, it's different because you're rendering a service. So it's really hard to measure your how do I want to say it? What's your lifeline? Your sales is your lifeline, and what's your profit? But the way that I looked at it was, as long as I'm understanding my profit margin, that will allow me to see what will keep us going or will make us better, or what's going to make us sink. Would that be a good way to look at it?
Yes. So Tiffany, I gather you're a consultant or planning to be a consultant?
Yes.
Okay. So you don't have the traditional variable costs like the coffee company does, but I would suggest to you that you do have some costs to consider. Among them are opportunity costs. The question is, what can I be doing with my time right now versus, generating the next sale? I would also suggest to you, as you think about your own economic model, to be really careful about inventory. You might be thinking right now, and those of you guys in the room might be thinking, well, wait a second, Tiffany doesn't have inventory, she's a consultant. I would suggest to Tiffany and everyone else that she does have inventory. It's called the number of hours she can work in a week. And that is kind of the choke point for Tiffany. Tiffany's limited in the sense of her business model based on how many hours a week she can work. And her big challenge will be, how many of those hours can I turn into billable hours, revenue generating hours? And as Tiffany and her business evolve, she will get out of being a one-armed paper hanger trying to do everything, and will look at her hours that she works and say, I really only want to work on revenue generating hours because that's what's really going to focus my business. And I will hire someone to backfill for me on these other non-revenue generating activities. So there's an opportunity cost every time Tiffany doesn't generate another billable hour as she's doing her books or marketing or whatever it might be. There's an opportunity cost because she's not billing out that hour. So she still does have a question of margin, but she also has a question of inventory that a lot of people wouldn't even consider.
Thank you so much, Ken.
Yep.
That was very helpful.
Great. We can move to Jason. Go ahead.
Hey, Ken, this goes back to what you were saying about like logical business models or business planning through that?
Mhm.
How do you take like Tesla, for example, and say that that was a logical business plan, because they're still not making money even after all this time? So could you maybe explain that better? Not, it might not be a right example, or if you have another company that you could,
Well,
you know,
yeah, Tesla's ability to stay alive isn't based on their operations. It's based on their ability to gain incremental capital all the time. On its own, Tesla's business model is a failure, I would maintain. Now, that doesn't mean go sell your stock, but if you just look at the business model itself, um, they they built a model anticipating higher volumes than they delivered upon. Their model was to try and sell an electric car cheaper. So they were prepared to suffer smaller transactional margins in exchange for higher volumes. And that was their model. And they also limited themselves a little bit in terms of revenue drivers. They have two or three main products in their line. They're trying now to develop additional revenue drivers and broaden that. But due to operational complexities and complications in getting their plant working and up and running, they haven't been able to sell the margins, or sell the volumes that they had budgeted for. So while their plan initially made some logical sense, they were going to trade off lower margins for higher volume, and they haven't delivered on the higher volume because of operational problems at their plants. That's why, as a company, they're not standing on their own 2 feet with organically generated profits. Their ability to stand on their own 2 feet continues to be how much outside funding they can get to keep doing it. Now they're at the point now where the worm is starting to turn. They're starting now to be able to generate enough in the way of volumes to justify their economic model, and to now start to stand on their own 2 feet. But had it not been for Elon Musk's big wallet and those of his financiers, we wouldn't be having this conversation about them as a current company.
thank you.
Yep.
Awesome. All right. So, kind of to close us up, because we've actually gone over a lot of the information, and I really appreciate it in a very succinct way. Kind of to close up, I was wondering if there's anything that that I maybe have asked at some point in the last two, if you remember some topics that we talked about that I haven't covered, or something that's important that we might want to share here at the end. Because I know Ken usually always has something on reserve.
I'm wagging my finger at you.
Too, so I know there's something that I forgot.
Eva, do you have something? I have something.
No, not immediately. Go.
All right.
No.
Let's talk about documenting your financing arrangements. Remember where this is going, Deanna? Okay, so
yes,
most of us start our businesses out putting our own cash in, and frankly, turning to friends and family as the initial round of funding. Please, I beg of you, to document the arrangement you have with your friend or family member from whom you're getting capital. Are you borrowing money? Is this a loan? If it is, let's document what the interest rate is. Let's document what the repayment terms are. Let's document everything there is there, so there's no question about what we have. Alternatively, if we have an equity arrangement, someone's given us money and they want to be a partner, let's be clear. How big a partner are they? Do they have voting rights? Do they have a seat on the board? How much equity do they have? Let's be clear that I don't have to repay them on a term certain like I do with a loan. And I need to tell this story because it's so timely, because we just passed Thanksgiving, and a friend of mine, and Eva's probably rolling her eyes because she's heard this story too many times now, but a friend of mine, he formed his business and he got some funding from a family member. He got $50,000 worth of funding from his uncle. I don't remember his uncle's name in the story, but let's call him Uncle Bob. And 2 years later, my friend's business had blossomed. It had grown wonderfully. And he never had set up a deal with Uncle Bob as to what the arrangement was. But he knew that Uncle Bob was in his corner. And at the Thanksgiving table, he stood up with great fanfare at the end of the table at the beginning of the meal and said, I really want to have everybody understand just how important family is. I tried to start my business a couple of years ago. and I couldn't get funding from anywhere. The banks couldn't help me. I couldn't find any funding, and there was Uncle Bob, and he came to the rescue, and he came through in a really big way. And as my friend passed an envelope across the table to Uncle Bob, he said, "Uncle Bob, I want you to know there's the $50,000 you gave me, plus another $15,000 for interest over those 2 years. And I want you to know that you made all the difference in the world for me, and this is what family is all about." And Uncle Bob looked at him with just totally blank look on his face. All the blood had drained out of his face. And Uncle Bob looked at him and said, "But I thought I was your partner. I thought we were 50-50. Okay. Let that sink in for a moment. Today, 5 years later, my friend has a 50-50 partner named Uncle Bob. Okay. Because after that speech, there's no way that he was going to be anything other than a 50-50 partner after my friend just talked about the importance of family and all the rest of that other stuff. My friend broke the cardinal rule. He didn't declare what the structure of the transaction was. And sure, he's got a business today because of Uncle Bob, but because he was stupid, very simply, because he was stupid, he now has a 50-50 partner when he thought he had a debt lender. So please, for everyone's sake, yours as well, be sure that you document the nature of the transaction.
Oh, that's great advice. Great advice. Sorry, you can hear my dog whining in the background.
Yeah.
Usually I let him go to, oh, there he is. Usually I let him go to daycare on these days so that he's sleeping, but today he did not go. So I appreciate that, Ken. Eva, do you have any last things to share with us? Anything?
No, I'll just kind of piggyback off of Ken from a documentation perspective. Just kind of, the banks right now, we're kind of still knee deep, and I'm sure everyone's heard of the PPP program and SBA. And there was a lot of chatter about some of the smallest businesses being left out of the kind of process. And what we've determined and what we're seeing is that a lot of small businesses that were not able to take advantage of the PPP program is because they didn't have proper documentation at all. So in addition to properly documenting transactions, whether it be from friends or family, I just want to stress the importance of documenting everything and keeping it. So good record keeping from the beginning, making sure that it's handy. So when you do meet with an investor or a bank or even applying for a grant or whatever it is, the first thing they're going to do is ask for some financial documents. And, it would just behoove you to kind of stay up to date and keep it right at your fingertips so that you don't miss those type of opportunities, because it happens. And we're seeing it even in the forgiveness process. These folks got these PPP loans and God forbid, they just didn't document it properly. And now their bid to have that debt forgiven is just not, it's just not able to happen because they didn't document properly. So I can't stress documentation enough.
Thank you. That seemed like it was one of the most important things to share, and yet I somehow missed it. So thank you, Ken, for reminding and getting us on track in that way. Well, if no one else has any other questions, I know we shared a lot of information here. We can go ahead and end early, and that is fine. I know I'm sure it's been a long day for everybody as well. I know Ken mentioned he's also had a long day. I'm sure Ava has too, and I've had a very long day. So, but I did want to just mention one thing. I'm going to send out an email tonight. We have a virtual conference happening tomorrow. And I'm going to send you out a login information if you want to take a look at it at some point. It's really more for people who are just trying to find out about entrepreneurship and what it is, but thought you might be interested. I'll send you the agenda as well as the login information to view if you'd like to log in at some point. Just wanted to mention that for all the people that watch the recording, they'll know why they received the email. So just figured I'd send that out to you, let you know we got some interesting things happening. We have a pitch competition happening, so it'd be pretty cool to watch. Anyways, now that I've said my piece, I just want to thank you again, Ken and Eva, for joining us today and for the last two cohorts that you've joined us with. I thank you so much. The information that you both share is invaluable. And there's a lot of people we could get to come teach these subjects, but not in the way that you all do it. And so I really appreciate that and the understanding of the demographic that we teach. So again, thank you all. Thank you to the class. Have a good week. Don't forget to turn in your homework by Sunday midnight. Please connect with Sandra if you're behind and need some extra work. And we'll see you next week on Wednesday at 6 p.m. from 6 to 7:15. All right.
Thanks, everyone. It was a
Thank
pleasure.
you. Bye-bye.
Great.